Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. There's the Aussie US dollar. Got up into the barbed wire, as we call that. Last week when we covered this, we had that first resistance level there. That was our 60-day pattern. Basically take that high to the low and extrapolate your retracement there, and you couldn't clear the 2/3. You know, it was interesting. I was teaching this week and we were covering the Aussie, and I realized, well, that's the 60-day pattern. What about your secondary pattern? So you take that a little further back. The 60-day was bearish, but then you go back and you take the high of the last 120 days, 150 days, I think even. It doesn't matter, secondary pattern. You take that high, that low, draw your retracement, and look what it gave us. It gave us that 2/3. And bam, it kind of hit the wall there. So you couldn't close above that. We see this quite a lot where you'll take out intermediate term resistance and then bam, hit long-term resistance. And that was the case there. We're studying that phenomenon too, and I wish I had more information to tell you that, yeah, you can go ahead and start selling rallies in this guy right away as a day trader. We're definitely working toward that. When we see a major shift in the market, such as you had here, definitely a change of direction like that, shift in momentum, we want to get in as quick as possible as short-term traders on the short side. Again, I wish I had more data for you to green light that, but that's what we're working on right now. And I think one of the reasons we're so successful at what we do is, number one, we have the right mindset. That is, we understand that markets are fractal in nature. No doubt about it that what happens on the lower time frames is representative of the higher time frames. Vice versa also. What happens on the higher time frames definitely representative of the lower time frames. It's really all self-similar behavior. So, number one, you got to have the correct mindset. For us, markets are fractal in nature. Number two, the method. All we're doing is buying dips and uptrends and selling rallies in downtrends. That's it. That's really the golden rule of trading, right? Buy dips and uptrends, sell rallies and downtrends. We're just really good at identifying uptrends and downtrends, right? So when you peel out, you look at your secondary pattern, you go back 120 days or so, you take that high to that low, and you see it hasn't been able to retrace more than 2/3 of that. Well, then that pattern's still bearish. So for our money, secondary pattern bearish. Definitely, it gave a sell signal here. We're still working on that. We still want to see more data as far as green lighting sell signals right away. But yeah, that's something that we're working on now as far as our fine-tuning it to where we have a position trade. You guys that have been following us for some time, you're familiar that we really focus on day trade. We started out as day traders, then we're kind of rolling up the timeline there. We've had pretty good luck too in studying intermediate term trading, swing trading. And what's fascinating to me now is that now we're taking a look at position trades, and that's even easier for us to do because all you need is a daily chart for that, right? Okay, let me get off my soapbox there. You got me going. Next market, dollar Swiss. You guys have heard me say it a lot that hey, this is the the trade of the decade. Just a monster potential investment. The market jumped up Friday, and that's what we were referring to last week here. The trick is right now that you have to maintain a big enough long position to where you've got skin in the game when this guy motors higher, because we believe it will. But at the same time, you're definitely in a slower time frame for the U.S. economy right now. January, February, going into March, very, very slow time for the world's biggest economy. So you're going to see backup anytime you get a frightening U.S. number. Everyone's going to think, hey, the wheels are coming off the wagon. We see that as just a short-term cyclical, but the big picture that what we keep talking about is you got to keep your eye on the prize here. Here's this chart on a monthly basis, and look at that massive potential breakout that you have. So we think there's a ton of room up above in dollar Swiss. Again, the challenge is in sizing that position so that a pullback is not going to hurt you, but at the same time, if it takes off, you're going to have enough in the game to make that exciting, i.e. make money, right? So we love dollar Swiss long term. Nothing's changed there. Dollar index itself, same story. Boy, look at that beauty, huh? Right on the 2/3. I mean, right to the 2/3. That's such a cool chart. Basically, you're taking the September low to the high, taking that rally, drawing that retracement. And we understand Dow theory. Charles Dow said it, the market retrace up to 2/3 and maintain that primary pattern. So pattern here, very definitely bullish, and that's what we look for, buying dips and uptrends. So same challenge in dollar Swiss and trying to size that position to where you're comfortable if it backs down against you on perhaps negative U.S. economic data that we're going to see over the next month and a half or so, and having enough on when that thing accelerates in the spring. Bottom line, the secondary pattern and the primary pattern are still up, and now you have all your short-term patterns up too, with the exception of that 60-day. That 60-day is a tough one, though. That's a tough nut to crack. So you're at potential resistance here, and that's why I'm reminding you, hey, you got to have that position size because you want to get a backup here, and you don't want to get nervous if that thing backs down a little bit and starts to, you see your account starting getting whittled away there. You have to understand that's part of the game and have that sized correctly. I always tell my students, what's your number? What's your number? Like, what are you comfortable risking per contract? That's such an important question to know so that you don't get in over your head. You don't get greedy on the way up, and then it starts to back down a little bit, and then you get forced out, you get panicked out of there. Next market, Euro, US dollar. Big turnaround in the Euro. Like to see it, and there's a case where the market hit resistance at that all-important secondary level. Yeah, that secondary up there, it held lower. It held down. Oh, I got to update that. That 30-day shifted down. Now, hit resistance at the secondary. You had the big turnaround. You had the big sell signal on the daily chart, and it's been down ever since. And that's something we're working on, too, as far as perhaps even it would almost have to be a second day trading method. When we see a big turn at a big level like that, do we go in that much quicker as day traders? And we've got to run the data on that first, but potentially that's something we're pretty excited about looking at too. Yeah, very excited overall. I mean, we know we're solid on the day trading. We know that helps complement the swing trading and vice versa. And then the next step, I guess it's been a natural step for us all along too, would be have a position trading methodology too. So, and you see that there when you get to those big secondary levels. Look at how it held, turned around, and bam, nothing but downside. Believe me, there's a way to take advantage of that from a trader, and we're looking at that too on the longer term levels. Next market, the U.S. stock market. We said last week, you got that big double bottom in place, and we think there's more upside than not here, and that's definitely been the case. You had a pretty good week this week in U.S. stocks. Yeah, you can't expect smooth sailing all the time, though. Again, I keep coming back to that time of the year for the U.S. economy. Hey, this is when it's tough. This is when the slow going. This is when companies are restocking. They're spending money, bringing in stock for the new year rather than making money. And everyone's keeping their fingers crossed that we get an early spring so we can get the ball rolling again. On the buy side, in the consumer economy, and there's always question marks this time of the year, but from our perspective, it's no time to get nervous. If anything, again, you got to keep your eye on the big picture here, and for us, the big picture in the U.S. stock market. Here's the weekly chart where you can see you broke out in 2013. You had a heck of a rally. Now you had a nice 50% retracement of that. You got a nice a smaller double bottom inside a larger double bottom, self-similar behavior. So, hey, we like nibbling. We like going back into the U.S. stock market at that level. Gold market. There's gold, the big picture, the weekly chart. You can see it worked its way all the way back to that primary resistance. We still see a downtrend in place. I think that chart says it all for gold, right? You definitely don't want to be a buyer of gold at these levels. So it's a guy here where you're going to continue to monitor that. Take a look on the daily chart, and you can see it's just starting to roll over there. It looks like you just had, let me see, is that red line? Well, you don't quite have a sell signal on those moving averages. They haven't quite rolled lower yet, but that's definitely something to watch. You're at long-term resistance, and that's not the time you buy a market. If anything, that's the time you look the other way. You look to potentially utilize leverage at those historic levels. So gold, watch that. We'll continue to see if it rolls lower. Last market we'll cover the U.S. 10-year note. That's essentially interest rates for us. And here's another guy where, boy, that's a huge level. If you look at a monthly chart, there it is. What is that, a grand pattern or a super grand pattern? Anyway, that's definitely a long-term pattern. Well, I guess it'd be a 5-year pattern, so that makes it a grand pattern. So you're just below grand pattern resistance. Back down to the daily, you had a heck of a move here, and now you're seeing this rolling lower. Looks like you have a sell signal right there in the way of that change of direction. essentially the market closed below the low of the highest closing candle. That's significant. That's your highest closing candle right there. When you close below the low of that, something changed, and that's definitely the marker that the direction changed there. So that's definitely something to keep an eye on. Essentially, that's dollar bullish, right? Our turnaround in 10-year notes, 30-year notes, that's definitely going to spell higher interest rates in the States, and that's dollar supportive. So, it always comes back to a strong U.S. dollar, and essentially that's our core position overall. I'll leave you with this chart, my favorite chart of the dollar Swiss on the monthly. A lot of room up above. My name is Jay Norris. I teach trading and analysis at Trading University, and we'll see you next week.